When we looked at the markets last week, we could start seeing dojis or indecisions starting to show up in the Dow. The Friday sell-off, a bearish engulfing in the oversold area, was giving us the possibility that that bearish engulfing signal, which is actually a bullish signal, telling you that was the last gasp selling. However, in today's trading, we could definitely see that the price movements of the market was influenced greatly by knowing whether there was going to be a House bill passed to help uh, relieve the economic situation. And the NASDAQ also showed that, where it was oscillating up and down as the prospects of a relief bill was looking like it was going to pass, and then sell off when the relief bill looked like it was not going to pass. So what this basically told us was the market, after flattening out, as we can see in the NASDAQ, is kind of waiting for something to help stimulate it to the upside, with the relief bills being an important factor. So although the recommendation has been to stay relatively heavy in cash for quite a few weeks now, there is still the benefit of being able to identify which specific stocks might be acting positive. Our recommendation on Zoom last week was based upon this J-hook pattern setting up. So the reason that we kind of stress and identifying the patterns as well as the signals allows investors to still be committed to positions even though the general market might be going greatly against them. So the strategy at this point is you could be predominantly in cash, but there are still some good chart patterns that are working effectively. Patterns also have two benefits. One, there's a high probability of knowing which direction it's going to go. And two, there's a good estimate of what the magnitude of that price move will be once that pattern gets moving. And candlestick analysis allows us to identify and what we call reverse engineer, analyzing which sectors are acting strong. The grocery stores, as we can see in our recommendation as SPTN, was based upon bullish engulfing signal, scoop type pattern, a doji sandwich, and still trading not only above the T line, but staying above the 3T line. Once again, it's not rocket science to identify the same patterns that have worked effectively throughout history that the Japanese rice traders have identified for us as being high probability trade setups. The patterns become very effective. A Morningstar signal, bullish confirmation, and what we saw in quite a few stocks today is our doji sandwich, a bullish candle followed by a doji. When you apply the simple doji rule, if it trades positive after a doji, the probabilities are it's going to trade positive. That tells us we've got a doji sandwich confirming our buy signals and telling us the T line is not going to act as resistance anymore. Stochastics coming up puts us in a high probability trade setup that we're going to have more upside. Where would be our likely target? The 50-day moving average, because there's a gap to fill up here. This is not rocket science. This is just taking advantage of the investor sentiment setups or the graphics that the Japanese rice traders have illustrated to us for hundreds of years of how normal investor sentiment works. Note the same scenario on Roku. A doji sandwich after buy signals, a piercing signal, a doji followed by bullish confirmation, then followed by a doji sandwich breakout through the T line. Remember the significance of the T line. You're in a downtrend until you see a candlestick buy signal and a close above the T line. The fact that we did a doji sandwich breakout gives that much more credibility to that reversal because of the signal itself and the fact that it told us the T line was not going to act as resistance anymore. Identifying the strong candlestick signals helps an investor put their money in the right places at the right time. Netflix started an uptrend. Today, note what it did. It closed here, or opened here on Friday, closed here. Today, it gapped up and moved the opposite direction. This indicates what we call a trend kicker signal. A trend kicker signal is not something that reverses at the bottom. It basically tells you there's more strength in this uptrend. So out of the big traders, Netflix is very viable because that trend kicker signal indicates there's probably more upside. Notice what started the uptrend. You had a big hammer signal, didn't confirm. You had a big inverted hammer signal that did confirm. Now you can see every time it opened, they traded it higher. This tells you there was strength coming back into Netflix. Obviously, you can do your reverse engineering by seeing the strength in this chart. Probably everybody's having to sit at home is probably using their Netflix or getting Netflix accounts. That information is pretty much illustrated by the signals, the stochastics coming up out of the oversold area, closing above the T-line, and then continuing to do strong trend continuation patterns. Once again, puts you in trades, even though the rest of the market may not be moving well, you've got positions out there that you can profit from. That'll be it. We'll see you in the chat rooms.